Accounting, this is the term account plus ing joke, accounting. Accounting are involved some basic or fundamental words, identifying, recording, classifying, summarizing, and reporting to the interested parties. This process is called accounting. First order available, identify. You have to identify this is a transaction or not. If transaction, you have to go next process, recording, then classifying, then summarizing, then reporting. This total activity is called accounting. Okay. So recording in the primary book, the journal book, classifying in the ledger book, summarizing trial balance, reporting the financial statement. In the financial statement, there are different parts or component. Say, for example, income statement, balance sheet statement, cash flow statement, owner's equity statement. Okay, this every part are lead to reporting the financial scenario, respective financial scenario. So this activity is called accounting. Financial accounting also same, but financial accounting they deals with the financial purpose. Financial purpose, identifying, recording, summarizing, reporting to the interested parties. This is the financial accounting. Financial accounting basically deals with the past event or transaction. Financial accounting, pure financial related transaction they try to highlight. Yeah. Okay, we know before slide what is the accounting, what is the financial accounting. Now I am going to my discussion point, the conceptual framework for financial accounting and reporting. Conceptual framework of financial accounting. You see that the three colors are design of the framework. First color, first level. In this level, the objective of accounting I try to discuss here and provide the information about the reporting to the interested parties. These parties, investor, lender, creditor, debitor, and so on. In this stage, that information are provided according to the take a proper decision. This is the first level of conceptual framework of financial accounting. Second level, there are mentioned the two slot or two segment in this level. That first, qualitative characteristics. You know that qualitative characteristic is a non-financial aspect of the accounting. Non-financial aspect. That's qualitative, not quantitative. Qualitative aspect are highlights here two types: fundamental qualitatives and enhancing qualitatives. Fundamental qualitatives means they leads with reliability and relevance, or relevance and reliability. Relevance means they have to chance to take a decision. There is no any rigid point. Just take a decision base. You can choose anyone. This is the fundamental qualities, relevance, purpose. And another fundamental quality is reliability. Reliability means the verifiable users use the information that is verifiable. So relevance and reliability, the fundamental qualities highlights. Another enhancing qualities. Enhancing qualities, that is comparability and consistency. Comparability means same quality or homogeneity trend or homogeneity figure you can compare between them. This is the enhancing qualities. Another relevant or consequence. You have to follow the consequence. The same system, same policy, same rules and regulation. This is the enhancing qualities. Another side are try to design a circle element of financial accounting. Which element are used in financial accounting? There are a lot of elements are used in the financial accounting, but some important elements are tried to highlights by the circle, red color. Asset, liabilities, equity, income, expense. This is the main element or component of the financial account. So this is the second tier or second level at focusing of the financial accounting. And another third level is step of financial accounting in the framework. This level deals with four component assumption, principles, and constraint. Actually, this the guidance to design a set of rules and regulation about this accounting purpose. To make a good standard rules, regulation, or policy, this segment. So assumption are there are highlights by four, five principles highlights at four and constant are highlight here too. But constant actually another two constant they are available, but the basic or main constant are cost benefit constant and materiality constant actually two. But some books or some experts they are trying to highlight there are minimum four constant in financial accounting. Okay. So assumption means when a primary stage to maintain or run the accounting, they try to assume and try to maintain the accounting. In this purpose, this rules and regulation is called the assumption. Assumption actually economic entity. In this assumption, owners and business institutions have to consider separately. If owner give anything strongly or separately writing, and they have to give any benefit, you have to write strongly or separately. This is the economic entity. Going concern in this assumption are consider or assume that the institution going on non-stop on the upon time. Monetary unit, the transaction have to determine by money or measurement by money. If you cannot able to measure by money, you cannot calculate. So this assumption deals with the monetary measurement unit. This money may be dollar, maybe taka, maybe rupiah, pound, ceylon, lira, and every so on. Periodicity means accounting institution or accounting follow a specific period. In this period, you have to close your account. This period may be 3 months, maybe 6 months, maybe 1 year. Another accrual. Accrual means if any transaction or occurred, you have to recognize. You may take cash money or not instantly, but you have to recognize your expense, your earn. Okay. You may give or you may take cash or not, but you have to recognize this is a transaction. So this assumption that primary states are followed to maintain the accounting, and gradually the assumption are updated. Then another some rules and regulation are considered. These rules and regulation is called the principles of financial accounting. At first measurement process, you have to critically measurement a transaction. This measurement by financial instrument may by maybe by non-financial instrument, but you have to critically measurement. Revenue recognition. Revenue recognition, these principles, you have to maintain the matching principles. Matching principle means how much income you express equal to expense and revenue. How much revenue, how much expense you have to disclose or you have to focus. Another principles, expense recognition. Expense also recognize. You may give and take cash or not. You have to recognize. Full disclosure. You have to disclose completely, not partially disclose. Completely you have to disclose to the interested parties. Okay. If you are not able to disclose fully, investor or other parties are lost their belief or confidence on you. So in this purpose, you have to disclose everything completely. This is the criteria of the principles. Another is a constraint. In financial accounting, there are some constraint or limitation to maintain the account. At first, cost benefit constraint. Cost benefit constraint in this purpose, cost are denied if the cost are cover the benefit. If benefit more than cost, if just recognize, other else nothing. But in every transaction, in every situation, the business are not possible to maximum benefit gain. So this point is the constant. In this situation, uh, cost are maximum, then the benefit just height, no disclose. If you disclose your institution or organization loss or maximum expense, so investor or others beneficiary they lost their confidence on your organization. In this situation, some height to the parties. So this is the constraint. Another materiality. Materiality constraint in this system, ignore insignificant matters. Ignore insignificant matter. Say for example, the group of industries or large scale industries, very very low frequencies expense they try to ignore, not try to highlight, because very low frequencies the sense on your financial position of a company. Say for example, lowest tools, pins, rope, tape, stapler, these very small tools are tiny. These expense are give not significant level of group of companies. Okay, this is the materiality concept. Another example, say for example, if this material very small item, say for example, rope, pin, tape, very tiny tools. So these tiny tools are considered as a asset, a small company, but these tools are considered expense in large scale company. So here give the priority. So materiality deals with the priority or significant. Okay. Some institution that keep record, some institution not feel keep record on the basis of the priority. This is the materiality concept. And another two have industrial practice. The industrial practice, the depend on the custom or traditional or environment. Say for example, the one word are very popular in the area, but it is not standard, but also follow the company, this language. This is the industrial practice. Or, and another conservatism. Conservatism means just consider your assumption and then try to take decision. Say for example, if loss you can predict it, but profit you cannot predict it. So predictive loss you can consider, but predictive profit you cannot consider in your balance sheet or in your account book. This is the conservatism principles of constant of the financial accounting. So financial accounting concept, the three tier I try to discuss here. This is the fundamental and very important phase of the financial accounting. I think you practice this concept, you more learn than me. I think, I guess, I believe it. Okay. And now I am going to another point. Types of financial accounting. Actually, financial accounting deals with the two types of purpose, number of cash proceed purpose or cash accounting and accrual accounting. This is entitled as a principles of the accounting, okay, or standard principles criteria. Cash basis. Cash basis accounting is the method of accounting where transactions are recorded when cash is received or paid. When cash received or paid, instantly you have to record. This is the cash basis. Other else nothing. Accrual basis, you just recognize expense and income. You may give or take cash, but you have to recognize this is your expense, this is your income. You just recognize. Cash may be instantly or not highlights cash payment or cash taken. Just you consider as your expense or as your income. Just you have to recognize this is the actual basis. So financial accounting two types deals with two types: cash basis accounting and actual basis accounting. Very simple. Now I am going to another slide. Difference between financial cost and managerial accounting. The actually financial accounting, cost accounting, and managerial accounting are the main. So I try to highlight here there are some similarities or dissimilarities about this accounting purpose. You know that the financial accounting they deals with pure financial purpose. Cost accounting they deals or concentrate on cost related of a manufacturing company. And managerial accounting they deals with a decision based or decision making and the managerial aspect they try to deals. This is three types of accounting basically important in the accounting area. So there are some important phase or point I try to discuss here. Part objective financial accounting. There are main objective is record transaction and determine financial position, profit or loss. Financial position are try to determine by the balance sheet, and profit and loss are determined by the income statement. So balance sheet and income statement prepared are the main objective of the financial accounting. And cost accounting, ascertainment, allocation, and accumulation, and accounting for cost. That's when in manufacturing company you have to determine or control the cost. This cost allocation, ascertainment, cost distribution, allocation are the main focusing point of the cost accounting. Another managerial accounting is decision purpose. Make or buy decision. You have to take which one you choose. This is the managerial aspect. And these are the similarities and dissimilarities about this accounting on the basis of the nature concerned with the historical data. Historical data means the past data, past data. Financial accounting deals with the past data. Cost accounting they deals with both past and present data. Managerial accounting they deals with future based data. Principle followed financial accounting are follow as mandatory gap and rules and regulation. Cost accounting is certain type of rules and regulation they try to follow. And managerial accounting, there is no mandatory to follow rules and regulation. Thus, the based on decision and take proper decision. Use data, financial accounting, qualitative aspect are not recorded. Qualitative data no need record in financial accounting. Cost accounting, only quantitative aspect is recorded, only quantitative. And managerial accounting used of both qualitative and quantitative. This is a very basic or fundamental criteria of managerial accounting. Qualitative and quantitative both are there to highlight. This is the similarities and dissimilarities about the accounting, especially financial accounting, cost accounting, and management accounting. I am going to the coming point. Objective of the financial accounting. Basically, there are some important objective of financial accounting. Out of them, some important phase or point I try to highlight here. Recording of the financial transaction or financial event to ascertain profit or loss, to disclose financial position. Financial position means asset position and liability position. How much asset are available to meet up the liabilities? This is the financial position. To report the financial information and to facilitate the decision making. In this purpose, the financial accounting deals. or leading. So I try to discuss here some basic point about this financial accounting types, and financial accounting and others accounting, their comparative discussion, concept of financial accounting. I just try to something here.